A stock bubble is not a giant floating bubble that holds stocks of companies inside of it. At least, literally. Stock or asset bubbles are characterized by economic cycles that have rapid increases in underlying value far beyond an asset's intrinsic value. Bubbles are usually only defined after the fact, once they pop and the value of a stock or group of stocks tanks. Stock bubbles are figuratively a grouping of stocks that float higher and higher, like a bubble, seemingly for no reason. They eventually have nowhere to go but to simply pop and plummet back down to reality. So what really are bubbles and why do they happen? Bubbles can happen for a number of reasons, and they generally occur due to changes in investor behavior. Investors may decide that, say, the technology sector is where the most growth potential is, pour all of their money into that sector regardless of whether a company is good or not, pumping up the values of every single tech company. Eventually, though, only the good companies survive, and even the profitable ones may not deliver on all of their promises. When this reality sinks in, investors sell their bad stock, take their profits, and they usually do this rapidly, causing the bubble to pop. Strictly speaking, bubbles are economic cycles characterized by slow to rapid valuation growth, followed by rapid devaluation at an unknown time. Bubbles follow the trend of displacement, boom, euphoria, profit-taking, and panic. Displacement begins a bubble cycle when investors notice a new technology, something new to the market, or they can access easy money to invest cheaply. Then there's the investing boom, either in a whole market, one stock, a grouping of stocks, or any other asset. Once they boom, investors are euphoric about the valuations and all of the money that they made. Once everyone realizes they've made a ton of money, though, they take their profits. It starts slow, but in a bubble, it quickly accelerates, rapidly bursting the bubble. The people who waited too long to sell can lose everything in a flash. Don't get caught by a bubble popping. After bubbles pop, everyone panics because they don't know what's a good investment or not. Eventually, though, markets will stabilize and steady growth will continue. Investors can make a ton of money on bubbles, but they can also lose everything. Some of the best examples of bubbles are the dot-com bubble in the 90s and the housing bubble in the late 2000s. The dot-com bubble inflated the price of any stock related to the internet. Investors thought the internet was the next big thing. It was, and they gave any company venturing into this new frontier tons of cash, more than it was worth. Eventually, companies failed, and investors questioned exactly what the internet would mean for businesses. The stock market dropped by roughly 10% overall, but some companies dropped billions in value. The housing bubble was another notable bubble, but rather than rehash that, go watch our video on mortgage-backed securities here that explains everything you'd ever want to know about this bubble. It'll also give you a good understanding of the movie The Big Short if you're interested. Finally, many economists are wondering if the stock market in 2021 is a bubble. Only time will tell, though.